Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is John Cochrane. John is the Rosemarie and Jack Anderson Senior Fellow at the Hoover Institution, and he writes the Grumpy Economist blog. Previously, John was a professor of finance at the University of Chicago Booth School of Business. So welcome to the podcast, John.
Pleasure
to have you here. Before we get going, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us an overview?
Sure. My name is John Cochrane. I am a senior fellow at the Hoover Institution at Stanford right now. I used to be a professor of finance at the University of Chicago Booth School of Business for 30 years. I was once president of the American Finance Association. I wrote a textbook on asset pricing that PhD students seem to read, wrote lots and lots of papers. So I've been thinking about these questions for a long, long time and had the pleasure of teaching 30 years of incredibly smart MBA students, which forced me to try to make things more reasonable and accessible. So that's who I am.
No easy challenge there. You recently published on SSRN and elsewhere a paper titled Portfolios for Long-Term Investors. We're eager to have you walk us through what you wrote and take some questions along the way.
Great. I'll advertise the best place to find my stuff. If you Google me, you find my website. So it's much easier to just go to this is a trick for all academics, by the way. Go to the personal website. SSRN's hard to navigate. So you'll find all my papers on my website and also on the Grumpy Economist blog, where I try to make stuff that's more accessible. So portfolios for long-term investors. Oh boy, where do we start? I noticed that how we think about portfolio theory and how people do it is radically different. And this is one of the challenges I learned teaching MBAs. We teach this lovely portfolio theory, and then people go out into the real world and they do all sorts of crazy stuff that has nothing to do with the portfolio theory that we teach. So one of the two's off. And it's a fundamental reason. The world of investing has changed a lot since portfolio theories came out. We know now that prices aren't random walks. And that makes a huge difference. To give you I think one of the big problems is we look at portfolio theory as what's our one period rate of return? Well, I don't know. How long are you planning to hang? Are you planning to last more than a month or a quarter or even next year? I am. I hope you are too. Now, so why do we collapse a lifetime's investment program into a one period rate of return? Well, that makes sense if you think the world is a coin flip, that every year is exactly like the last year. So if you do something right for 1 year, then the rest of your life is just multiplying that 1 year over and over again. But what we know now about asset markets is that is not true. Right. That things in longer horizons look quite differently than they do in shorter horizons. And I think the story that encapsulates the long horizon perspective, this paper is Portfolios for Long Horizon Investors. So one story that I really think we need to, I'm going to tell two stories. And the first one is the long-term bond investor. So suppose you are you're a long-term investor, you're planning to live for quite a while, and you want to bequeath some wealth to your children as well. So your effective horizon is infinity. You want to live a long time and their children. Second, let's posit you're really risk averse. You don't want to take any risk at all. What's the right asset for you to buy? Infinitely risk averse, long horizon investor. The answer is not treasury bills. The answer is the indexed perpetuity. Now, no one's heard of that. What does that mean? What you want is a long-term bond, a bond that is so long that it is just coupons and not principal. And those coupons are indexed for inflation. So you want to buy a security that offers, say, $1,000 per year indexed to the CPI forever, a very long-term indexed bond. 30-year tips come close, but not really. Actually, this isn't, we need to go back in time. Queen Victoria financed her empire by issuing perpetuities. And under the gold standard, price level was constant over long periods of time. So in effect, index perpetuities have been around. And if you're watching Downton Abbey, most people like that started their investments by buying effectively indexed perpetuities from the government. This short-term stuff is all very recent investment. Now, this is... So here's a theorem. The index perpetuity is the proper asset for the risk-averse long-term investor. Now, I offered in thinking about how we do things, suppose that you do this, we're both men, so I'll say your wife, and you decide that this is your retirement program, you invest in these long-term bonds. She happens to open, interest rates go up next month. She opens the statement, you've lost 30% of the value of your portfolio. She goes, you bloody moron. What have you done? You've lost 30% of the value of our portfolio. Now, there's a lot about marketing. How do you think about this stuff? How do you sell to your wife that this was a smart idea? Look, honey, we bought this thing that gives us $1,000 a year indexed for life. It's perfectly risk-free. And she goes, but we lost 30% of our money last month alone, you bloody moron. So the modern portfolio theory, the way it describes that, involves dynamic programs and state values and derivatives of the value function and time-varying investment opportunity sets. You try to explain that, you're going nowhere. You try to say, oh, well, honey, look, as the price went down, the expected future return went up, so we'll make it good in the long run. Yeah, right. And how about when you shorted Bitcoin last year? That worked out well too. Sorry, if you've read the paper, I'm telling some of the same jokes, but I get the research.
They're good jokes. I don't mind.
So this example led me to think. So what the right answer is: look at how do you sell that as as entry into long-term portfolio investing. Well. So for one, what's going on? What's going on is that bond returns are not a random walk. We know when the bond price goes down, the yield goes up. Mm-hmm. When the price goes down, the return going forward goes up. And that's got to be crucial to bond investing. If you're doing your bond investing on one period mean variance analysis, you're completely blowing it. That's not how bond investing works, right? I'm talking about risk-free bonds, government bonds. When the price goes down, the yield goes up, the future return goes up. How do you both think about, and sell a portfolio like that? Well, looking at that stream of coupons, I think, is much more salient. Explain to your wife, honey, it's $1,000 free for. Just tear up those damn statements. They don't mean anything. That's better than saying, read the statement every month, calculate the cross derivative of the value function with respect to yield and the duration of increases the term structure of interest. So that was the opening to portfolios for long-term investors, that if we started thinking in terms of the stream of payoffs over lifetimes, we might make progress in understanding portfolios. Our world is dynamic. When prices change, expected returns change, volatilities change, different categories rotate in and out. I don't know quite how to do it, but I kind of know one step of the way is let's start thinking about what we can get out of this.
Yeah. So do you mind if I interrupt for a second, John, when I think about index?
You don't interrupt me.
So I think two things as I think about index perpetuities. One is, in a way, Social Security is a bit like that already. You're buying future index adjusted coupons in a way, perhaps.
Well, you don't have the choice of buying it or not, because it's an index perpetuity at a lousy rate of return. But yes, go ahead.
All right, that's fair, but it may exist in some form or fashion. The other is, you mentioned obviously Merton quite a bit in the paper. He and Arun Muralidhar have created selfies. Brazil just implemented or is about to implement selfies. Did they come close to what you're talking about in some way?
Tell me I thought a selfie was something you took from an iPhone on a long stick. So. What's a selfie?
It's a standard of living adjusted future payment coupon that you buy today for a future payment.
Like tips.
Well, like tips, but not based on CPI, based on standard of living.
Oh, okay. Now there's the issue of, is the CPI correctly measured in the standard of living, and the stages include the stuff you want to buy and so forth. That's,
right.
Those are actually, practical considerations that we in academia don't worry about. I would say that the point of the paper then was to take the same attitude towards stocks. So it is also true that when stock prices fall relative to dividends, that does not mean that future dividends are likely to fall. at least fully the amount of the stock price. There is some tendency for prices to take temporary falls and come back again. And so so stocks are in fact much better for long-term investors for that reason. And one way to start if you start thinking about that in terms of dynamic strategies and taking advantage of this, that, and the other thing, you head down a dangerous road. But if you start thinking of that about, I can buy a dividend stream at what price do I buy a stream of dividends or payouts? That same kind of thinking, I think, helps you to understand long-term investing in the stock market. The second issue is there's all this siren song of doing smart stuff. And I want to remind everybody of the average investor theorem. And it goes like this: the average investor holds the market portfolio. It's the definition of the market portfolio. Doing anything but holding the market portfolio is a zero-sum game. The only way you can win is if somebody else loses. Now you'll say, but of course I'm smarter than everybody else. And they'll say, they're smarter than you. One of the two of you is wrong by definition. So that thought, I think, that's a second basic thought that I think opens up a lot in one's attitude towards active management, towards doing anything but holding the market portfolio. Why are you doing something different from everybody else? We can't all, Garrison Keillor used to say all the children are above average. No, we can't all be above average. Now, when you think about modern finance, there in fact are reasons. So I think it's useful not just to say, I think the market's going up, so I'm going to buy. Well, everybody else thinks it's going down, so they're selling. Do they know something you don't know? Why? That can be paralyzing. But it is not true that we should all just sit on the market portfolio, because we differ in certain ways. So the advice I was going to give is that the advice I give, I think it's useful to meditate on who you are, who the average investor is, and why it makes sense for you to do something different from them. Now, the puzzle is you don't have to do this in the grocery store. You go down, I live in Palo Alto, you go down to Whole Foods and arugula is on sale, and you just buy arugula. You don't worry about the average investor at Whole Foods, because God knows what crazy, they're all buying kale today or whatever it is, chia seeds. But in financial markets, the prices are not so clearly posted as they are. It's not so clear what's an opportunity. So thinking about your function, where you stand in a market, I think is very useful discipline. And so we do differ. Some people are more risk averse than others. Now, everybody tells you that they're the one who bears risk until they lose money, and then all of a sudden they're the one who doesn't bear risk. But certainly thinking about, am I in a position to take some risk that other people are not in a position to take? So if there's a big recession, financial crisis, a lot of people are dumping stocks, even though they know they're good. I wish I could go back to 2008, December to March 2008. Send me a time machine. I'm going to go back and buy. Why did I not do it? Well, I was scared late. Now, it wasn't right to be scared. Different people have different reasons to be scared. If you have a business and it's 2008 and that business is about to go under and they're coming to repossess the car and the dog, you can't take risk, even though it might be a buying opportunity. If, on the other hand, you're a tenured finance professor and they can't fire you if they want to, and they're still sitting on a decent endowment, then maybe you're the one who should be taking risk. So there's a legitimate argument that undercuts the average investor theorem for who should be taking risks when. So that the paper goes on about 15 different ways of thinking about why I might be justifiably different from someone else and therefore want to take risks that they're not taking. And that gives at least it's a thought process that passes the efficient markets test of, I'm not just assuming that I'm the one who's smart and they're the one who's dumb, and they think the opposite of me, but I'm really smarter than everybody else.
In your paper, well, I'll start by saying many of the people who will be listening to this podcast are investment advisors, and in the paper you have a discussion about justifying fees. Do you want to chat about that for a second? Yeah,
I always felt that. So I'm very free market. Efficient market type. My office was next door to Gene Fama's for 20 years. And I felt bad about, I taught an MBA class and we charged all this tuition to go teach kids that they couldn't beat the market. And then what are they going to do with that in industry? So I want to find some reason for, and there's a good reason for a financial industry to exist. So in this same line of thinking, can we find one reason for fees is simply because people are willing to pay them. So good luck. They want to think they're the smart one and willing to pay you to pretend to be the smart one. Because the average alpha in the financial industry, as we all know, properly evaluated is a zero, a big fat zero, because the average investor holds the market portfolio. And then we're back on the same loop one, well, but I have the good advisor. Okay, how do you know that he's not bad? But in this way of thinking, if you think of the financial markets not as a casino, but as a place for transferring risks around from people who are able to take them to people who aren't able to take them, then there is a difficult, interesting shopping problem of how do you match people with the appropriate investments for them. And that's a difficult problem and worth charging a fee. So I like the idea of a fee-based management system, but I just want to find a good reason for it to exist. And that's a really good and hard problem. Try to identify what are the risks that you're exposed to and you shouldn't be investing in. And then identify the risks that you're not exposed to. And you should be sort of writing insurance to your fellow citizens and earning a premium for doing so. And that struck me. I don't really know how to answer that question. I know the basics. So stop investing in your own company to the extent you can avoid it. Stop and don't invest in the industry of your own company if you can avoid doing that. So the last thing you want is to lose your job, lose your business, and your portfolio tanks all at the same time. That's not a good idea. So diversifying out of your own industry and company is an excellent first step along that thought. And then, who should buy value? Who should buy growth? Who should buy different industries? One way of starting to think that is who has those background risks that they're trying to insure and who doesn't have them and should be writing insurance to the other people. And that's a good fee business if you could get that right.
There's a quote in the paper somewhere in the 53 odd pages that are in front of me about risk management. I found it. It says risk management should be the core of investing, portfolio management and evaluation, not a small afterthought.
Yeah. It's funny how when you talk to investors, we jump to the alpha without doing all of the other things first. And, people ask, what should we be buying? What's going to go up? What's going to go down? And the number one thing to make sure of is, what could go wrong? Let's make sure that we're controlling it, because controlling risks is free. Not investing in your own industry is free alpha. You don't have to be smarter than the other guy. You just have to not take risks that you're not able to take. And in fact, sometimes they pay you for that alpha. So number one, think about what are the risks you're exposed to in your other life. If you're a real estate developer, you're exposed to a lot of risks. Let's just make sure that your portfolio doesn't tank when everything else tanks. Let's think about, are you worried about how is inflation going to hurt you or help? What kind of macro risks are going to hurt you particularly versus other things? So, and then, what risks are you able to take? I talked to some universities, and let's go back to 2008 when everyone was selling, and they're selling their endowments. Like, what are you morons doing? You're selling your whole endowment. And the answer was, I understand that this is the buying opportunity of a lifetime, but if it goes down even more, we're out of business. Well, there's some risk management that maybe should have been done ahead of time, not after the fact. But think about what risks you're able to take. This is kind of like life advice in general. If I can veer off a little, I noticed the Federal Reserve keeps saying, "Here's what we think is going to happen, so here's where we're setting policy." Whereas you talk to a general, and that's not how they think at all. They say, well, if the enemy comes around the left flank, we'll do this. If they come around the right flank, we'll do that. If they launch a cyber war, we'll do that. They think first about the things that could go wrong and how they're not going to completely fall apart. And then they think about where's the alpha that we can go ahead. And that goes, we never, don't pay taxes. You don't have to. Stay legal. This is but I'm just amazed that so many investors take short-term capital gains. Why would you ever take a short-term capital gain? If you can avoid it, don't take a long-term capital gain. They're forbidden they're forgiven in your portfolio. There's just little simple things like this. And don't let your hedge fund manager take a short-term capital gain and pass it on to you. That's free alpha. Let's clean all that stuff up before we start chasing it smarter than everybody else alphas. And that's worth a lot of fees. It's not easy to do.
We had a question from a couple of readers. It would be great if you could clarify further your statement about the smoothness of dividend streams. One of standard assumptions for dividends is a constant payout ratio from earnings, but earnings are as volatile as returns. Any thoughts about that?
So dividends aren't a constant payout ratio of earnings. So back when companies used to pay dividends, in fact, starting around in the late 1940s, they started smoothing dividends a lot. And so as a rough approximation, dividends were paid according to what constant level of dividends they thought they could support by highly varying earnings. So it was already quite smooth as far as I could tell, roughly in a good forward-looking sense. Now there is some of my advice was, you buy stock for the dividends, and stop worrying. Don't try to market time your long-term bond portfolio. A good approach to long-term investing is to buy a stream of dividends that can support your consumption at a low price. Now that depends on companies paying dividends. Now that their portfolios pay more dividends than individual companies. So one of the problems, individual companies, many of them don't pay dividends anymore, and they pay them in lumpy ways. But a portfolio overall has a much smoother stream of dividends keyed towards its kind of long-term earnings. Second, dividends also, in the proper notion of dividends, includes cash payouts to shareholders. So when they liquidate the company and give you cash, or when the company gets bought by another company and you get cash, that counts as a dividend too. Now that's very lumpy for the individual company level, which is why you should be holding a widely diversified portfolio. And I talk about prices for the dividends. There is now another reason for active management, if you will. Since so many companies don't pay dividends, forming a steady stream of payments that a portfolio can pay off as if dividends is something that takes a little sophistication and is worth some fees to do. Because conceptually, that's what you want. It's like buying that bond and living off the coupons forever. You want to buy the stock and then live off of the very smooth earnings that it can provide. But these days, fewer and fewer companies are actually providing that as cash dividends to live off of.
Right, and your mother would complain about that, right?
Yeah, so I used my mom. My mom was old school. She's lovely. She was the type who bought stocks and then lived off the dividends. And that the market was set up for people like my mom. And, it's always a puzzle in finance. Why do companies pay dividends? Because of course, dividends used to be taxed differently than capital gains and so forth. And my answer was, because my mom buys stocks and she buys stock. And it was actually a very sensible system. They kind of said, look, here's what you should consume every period out of this stock investment, and they sent you a check. Yeah. Now we have to. That's it turns out we always made fun of that, but it turns out in a world where prices take deviations that come back again, where low prices mean high returns, where high prices mean low returns, an investor like my mom, whose risk tolerance doesn't change over time. An investor like my mom should be doing pretty much eating the dividends. It's kind of nice. So now we have to resynthesize that same concept on our own.
Right. Another question that we had from a listener was around the current expected returns for the markets and whether folks should be looking for income yield in other places like private credit, hedge funds, alts, et cetera. Any thoughts about that?
Okay, so these are two separate questions. One, overall return on the market. We academics have been puzzling over the equity premium since the 1980s. Most of the time, we're actually very good about it. Most of the time when economists say, hey, our models don't make any sense of this equity premium, the answer is something's wrong with our models. Yeah, we really bashed away on these models. It's awfully hard though. So when we started, the market was earning 7% on average more than bonds. Now the market's volatile, but especially over long terms, it's not that volatile. And it looked like owning stocks was just a tremendously good deal. I'll give you my view of where we've settled out. I think a lot of that was luck. That the post-war, and my thought on this goes back to my grandfather, who was actually a stockbroker with the great family timing. He set up business in the summer of 1929. And by 1945, he wasn't having anything of stocks. He put it all in municipal bonds. Now, did my grandfather in 1940, and that's why I have to work for a living, did my grandfather in 1945 know that the United States was about to embark on the greatest economic expansion in all of human history? I just looked up the numbers. Income per capita went up from $16,000 to $60,000 from 1985 to 2008. Nothing like that had ever been seen before. You read every economist in the newspapers in the 1940s. They were saying, we're back to secular stagnation. Here comes the Great Depression. That the stock market would offer 7 to 8% per year for 2 or 3 years. Nobody knew that. Because, and in the end, in the end, over long periods of time, once the price dividend ratio or price earnings ratio settles back down again, the rate of return on the stock market is the growth of earnings and the growth of dividends. They're all the same thing in the long run. Nobody knew we'd see growth like that. So I think a lot of it is luck. If you see historical 7 and 8% returns, most economists, most finance people I talk to now say you'll be lucky going forward to get 3 or 4% returns over bonds. But that's our guess. Never take any advice from a finance professor because we don't. The one thing we can, what I know with great certainty, I know with great precision why nobody knows the answer. But that doesn't mean I know the answer. So the overall, I would not look for a repetition of unless, maybe I'm wrong just like they were wrong in the 1940s. Mm-hmm. And maybe our little bout of inflation is about to make our government rediscover the supply side of the economy, get the hell out of the way, and certainly could grow again like that. So we need to just break all that red tape and get going. It could happen. I don't think it will, but it could. Now, the second question. So my guess, take it for what it's worth, is that the return on stocks going forward. But of course, I said that 10 years ago, and I was wrong. We had another great 10 years. And a lot of high stocks so the price relative to dividends rose. Now, the price relative to dividends can't keep rising. Right. So for a long period of time, it's the dividends that have to rise. And the real interest rate fell from 5% to about 0%. So 1 over R minus G, guys, but it can't keep going down. So to some extent, I think we've seen a higher price to the same stream. Then we saw unprecedented growth and we saw unprecedented rise in prices for the same streams. Those are one-time effects. Those don't keep going. Now, but that doesn't mean you can go find anything better anywhere else. That's the overall price of all securities, all risks. If stocks are high, well, bonds. What, you want to buy government bonds 1.86% for 30-year treasuries when inflation's running 8%? That's not a great deal. Credit spreads are all incredibly compressed, just like anything else. So rates of return on investment, real interest rates and risk premiums are all real low right now. So it doesn't mean there's anywhere else to go.
Right. Okay. All right. So let me go back to the paper. There's some things that you suggest about the how the world should look at portfolios for long-term investors, and you seem to suggest that that more research needs to be done, perhaps around the ideas that you're putting forward here. That they're not yet proven. Is that fair to say?
Oh yeah. Not fleshed out. Okay. So we have a theory. I don't make any technical contributions beyond Merton's 1972 theory, which actually we don't have any, very few technical contributions beyond that, which is, you write down a formal model of how you think means, variances, covariances, state variables work over time. And then you can add in transactions, costs, and credit spreads, and whatever model you want. We know how to churn out the optimal dynamic portfolio. Big black box, nobody believes it. So, I offer some conceptual thoughts. Think about the payoff stream. I wrote one paper that tried to actually compute things on payoff streams. It's hard to do. What is if we restate the game, instead of looking for one period returns, I'm just going to restate the question. Instead of looking at one period returns and trying to find high means for variances and covariances and betas, let's look at what stream of dividends, long-term payments we can get for an initial price and try to maximize that. So this is a suggestion. That's a good way to frame the question. The answers are mathematically equivalent. It's just that framing the question that way, I think, gets you a little more intuition and gets you out of the weeds of trying to model stock return dynamics very precisely. But it's all an invitation to go and try to do that.
I wonder, for many years, people thought Markowitz mean variance optimization worked well for those who were saving or accumulating for retirement, maybe, but not so well for those who are in retirement trying to create a stream of income. Does your thought here is that this would work in both phases of a person's investor's life, in accumulation and decumulation?
Well, I think it always worked. There's always for assumptions, there's conclusions. So it wasn't that we said mean variance optimization didn't. I don't think anyone ever said it didn't work, but that the answer. So here's a great question, which we ought to be able, after 50 years, we should have better answers to. Should you rotate from stocks to bonds when you retire?
Yeah.
Or should you go the other way? And it's kind of funny to watch. We said for a long time, no, you shouldn't, because everything's a random walk. And then people started thinking, well, wait a minute, things are a little bit different because as you get older, you're not going to live as long. Now, it turns out if things are a random walk, the original saying was, nope, doesn't make any difference how long you're going to live. But things aren't a random walk. Now it does make a difference how long you're going to live. So, if you do think that if you follow the evidence that stock prices can be low given dividends for a while, then in fact, stocks are riskier if you have a short horizon than a long horizon. So now that just says that doing the proper Markowitz and Merton thing says that since you're not going to live so long, when you're older, you should go to bonds. But just as soon as that got implemented on Wall Street and target date funds got put in, people are, oh, wait a minute. A lot of people want to save not just for themselves, but for their kids. Wait a minute. Now your horizon might not be limited. In fact, maybe you're willing to take more risk for your kids than you are for yourself. The problem got more complicated because you also, while you're working, you have the risks of your job. Now, the first round of modeling said the risks of your job are like a bond. So you should get bonds out of your portfolio because you're receiving this like this stream of bonds while you're working. And then you should put bonds back in your portfolio when you're older because you've gotten rid of that bond-like stream. But then we discovered that, wait a minute, people's wages they're not bond-like at all. Wages are really risky too. In fact, if you're a finance professor, your wages look a whole lot more like the stock market than like the bond market. When the stock market tanks, demand for finance professors goes way down. So maybe, in fact, you've been in your wage income, you've been sitting on a stock all these years, and you should rotate back into stocks when you get older. So the framework is I just said Markowitz. There's nothing Markowitz, Merton would disagree about the framework, but what numbers you put in changes over time. But at least we know how to think about it.
So what from your perspective needs to be done to flesh out the work that you have here? What?
If I knew, I would have done it. But there's a work on a technical end and a work. I think to some extent where finance professors have missed it is you have to not just work on the technical end, but work to sell it and to have people understand it. In the end, we are not a black box perfection. This is not engineering. If you model the wing of a 737, you can just put it in a big black box and the thing will fly till 520 miles an hour and then it'll blow up. You can't. What we do are quantitative parables. They are guides to thinking. They're not. You can't do black boxes. So that raises the onus on you to not just compute the answer, but to really understand what it's trying to tell you, to make this a guideline for human decisions. That's really what I was trying to do by recasting it in terms of the payoffs rather than the one period rates of return. That's right. My example about the long-term bond was don't think about the long-term bond in terms of the 1 month return on long-term bonds and hedging state variable uncertainty. Think about it in terms of the payoffs. It's the same problem, but I think that helps you to understand what the computer's trying to tell you. So more understanding what the computer's trying to tell you, I think.
Yeah.
But it is weird, so hedge funds, lots of hedge funds live on the whole idea that means variances and covariances are changing over time because, right, that they're dynamic strategy hedge funds. And what I do, one period mean variance optimization. It makes no sense whatsoever. So think about what you're doing. A great deal of just sort of think about what you're doing and why, I think would help a lot. I mean, where my paper started was noticing how do institutional investors, you graduate MBA, what are you taught? Means, variances, beta. You walk into any investment shop, and what do? You start with some allocation to stocks, bonds, alternatives, currencies, commodities. And you argue forever about those and real estate. And 57.2% to this and 22% to that. You don't even talk about the betas, talk about the covariance. You don't talk about the risks. You just make this allocation to names. Then you rebalance those to the last decimal point every month. And you're just thrown out the window. So we need to make some contact between how we understand this works and this sort of dogma that pervades investment practice.
Yeah. By the way, you do make mention of rebalancing in the paper. Do you want to talk about that for a second?
Sure. It's one of the first. I like to start with really simple stories. So my investor in the long-term bond portfolio, that's a simple story that just should unsettle you as you're walking home and listening from this podcast. So this average investor theorem, the thinking about equilibrium, what was said, the average investor holds the market portfolio. So if you're doing something different, it's a casino, it's a zero-sum bet. That includes rebalancing. Let's start at the market being 60-40, 60 equity, 40 bonds. If we start at 60-40 and the market goes up to 80-20 and you rebalance back to 60-40, somebody else has to rebalance upward. That's a step away from the market. The average investor holds the market portfolio without rebalancing. Now, you do have to buy, new companies that you have to rebalance in the sense of buy new companies. You don't want to be sitting on the Nifty 50 from 1960 as they slowly lose value. So when there's new issues, you have to buy them. When there's old ones, you have to sell them. But rebalancing in terms of like equities versus bonds, the target is 60-40. That is an active management game. That's a dynamic strategy. You are market timing when you do that. So at least if you're going to do it, throw it into the market timing bucket. Don't think that you are being passive because you're rebalancing. You're not. The average investor doesn't rebalance.
Yeah. All right. It's a very long paper. And I want to leave folks with the takeaway. If there's one or two things that people should take away from reading this paper, what would it be?
Don't worry so much. Pick an overall level of equities versus fixed income. Just sit on it, and it's a great excuse for doing nothing, which is what I tend to do. All right. And then, secondly, first one, don't feel like there's this kind of game. It's just taken for granted that you have to play this rebalance, actively churning your portfolio, active management game. No, you don't. Basically very low fee equities, very little rebalancing is just fine. Second, unless you're different. If you really know you're smarter than other people, go for it. If you really know that you're different from other people in some other way, then go for it. If you're prepared to take risks others aren't, don't go for it. So that would be the first one. And secondly, risk management. Stop investing in your own company, stop investing in your own industry. Think about what the risks are in the rest of your life. Most investors are small business people and they have a business risk. So just think about your portfolio in the context of insurance against your business. And wages, all of us, in the modern economy, nobody's wages are certain. So just make sure that when you get fired and your business fails and your industry tanks, that your stock portfolio isn't doing the same thing.
Yeah. All right. So great advice. Let's just turn our attention briefly to your blog, The Grumpy Economist. Couldn't think of a better blog title. You've written recently about inflation and
comes from my kids, not from me.
Fiscal policy and monetary policy.
Yeah, welcome back to inflation. It's the 1970s again. We never thought we'd see that, did we?
Well, we're not in double digits yet, right?
Not yet. Hang on.
So tell us your point of view on where we are and where it's heading.
Ooh. I think it's real simple. Why are we having inflation? Well, there's demand and there's supply. The government basically printed up $3 trillion of money and sent people checks, borrowed another $2 trillion of money and sent people checks. Milton Friedman said you get inflation if you drop money from helicopters. We dropped about $5 trillion from helicopters. No surprise, we got inflation. That wasn't all a stupid thing to do. During the COVID emergency, the government did rightly sort of fall into, and we didn't want to let companies go bankrupt. They'd never go bankrupt. We wanted to support people needing support. It was done with tremendous waste, sending stimulus checks to every registered voter. Sorry, every taxpayer. People living on. Everybody loves a check, but there were lots of people who were not hurt by COVID who got checks. But anyway, you send that much money out, of course, you're going to have inflation. Now that it doesn't have to go on. Whether it keeps going depends on whether monetary and fiscal policy in the future keep the inflation going. But we have crossed a little bit of a Rubicon. We have normally when the government. Why didn't all the previous stimulus programs work? Well, people kind of figured the government is borrowing a lot of money and showering it around, but they're going to pay it back. The fact that we have inflation means two things. It means, one, people's faith that the US government's going to pay back its debt has now been questioned. And that puts us ever closer to that fiscal danger when people say, well, they're not going to pay back the new, they're going to keep borrowing. This is the question for our time. When they borrow another $1 trillion next year, do people believe that is going to be paid back? Or they say, well, we're into the territory of not paying back. If we're into that territory, we're in deep trouble. It's sad for me to see also the Fed and the administration. This sounds like my old Crosby, Stills and Nash records, which I still listen to. I'm old enough, but it's from that era. Oh, supply shocks. Oh, greed. Oh, the oil companies are getting together and raising prices. Oh, we need price controls. I mean, and these people are old enough. They lived through the 1970s too. Maybe they have Joan Baez albums or whatever on them. And no, more seriously, I see a danger of slipping into the same mistakes. The Fed has announced that you read their monetary policy strategy, and it reads like a description of monetary policy of the 1970s. We want to let inflation run hot to try to go down to less unemployment. That's the Phillips curve, 1963, that we found out doesn't work in 1972. We're going to let inflation run really hot before we do anything about it. It's exactly what they did in 73, 75, and 79. They're not even, the one tool they have is to replay 1980. And they're not even willing to say, what we're going to do about inflation is we're going to cause one mighty recession and stick with it if we have to. They're going to say that. And this time the debts make it, if we get into inflation, getting out is going to be harder. Because we got 100% debt to GDP ratio. In 1980, we had 25%. So if the Fed raises interest rates 5 percentage points, that's $1 trillion of extra deficit. And that has to get paid. So, the only way out of it involves, and we have structural deficits like we never had in the 1980s, 70s, and 80s. We have Social Security and Medicare about to go bankrupt that we didn't have in the 70s and 80s. So if we get into inflation, getting out of it is going to involve a really serious fiscal reckoning that wasn't the case last time. And what inflation is showing us is that the supply side of the economy has been really hobbled. We're just not capable of producing the amount of stuff we want to. Why? Well, in part because we're paying people not to work, in part because there's tariffs and regulations and rules everywhere. So what it's going to take is like in the late 70s, a supply side deregulation, like in the 80s, a fiscal reform where we fix the stupid tax code so it raises money without destroying the economy, and we're going to have to fix Social Security and retirements, and the Fed's going to have to wake up and get back to inflation. Putting inflation back in the model, if it breaks out, is going to be doubly hard this time.
Yeah. So the Fed is calling for 3 or 4 rate hikes this year. Is that enough, or what levels does it need to be raised to?
I would rather, so back to our military analogies. The Fed is like, here's what the Fed says. It says, well, here's our forecast for inflation. So here's what we're going to do. Well, that worked out really well last year, didn't it now? Our forecast for inflation is there's not going to be inflation, so we're not going to raise interest rates for the next year and a half. And if the enemy breaks the left wing, well, we're still not going to do anything. I mean, I would much rather the Fed were talking about scenario nets. We're talking about how we will respond if X happens, rather than just here's what we're going to do because we believe in our forecast. If they have learned nothing from last year, shouldn't be that they don't know how to forecast anything. Now, what we have in store are a few small rate hikes. So that really that works if inflation goes back down. Let's take John Taylor's rule. I mean, it's not necessarily the only rule, but the sort of standard rule is you have to raise interest rates 1.5 times the inflation that you want to put out. Mm-hmm. Well, if inflation's 8%, that's a lot more than 3 rate hikes next spring. So they are certainly counting on most of the inflation going away on its own. If that's what happens, you got to get, at some point, you got to get interest rates above the inflation rate if you want to get back to normal. So 3 rate hikes, well, even if of the 8%, we're sort of at 8% inflation since last February. If that goes down to 1 or 2 all on its own, then 2 or 3 rate hikes will be enough.
Yeah.
I'll just leave that sentence hanging. If that goes down to 1 or 2% on its own, 2 or 3%, 2 or 3 rate hikes will be enough.
Yeah. I mean, do you think that the bond market is wrong when you look at the break-even rate, or?
Yeah. I don't know what the heck's going on with the bond market because how in the world is it still 2% for 10 and 30-year money? So maybe Team Transitory was right, and it's all going to go away. It was just a one-time supply shock, even though last time it wasn't a one-time supply shock, but we'll see. I would notice the bond market has never forecast inflation. So, go make a plot of 10, go to Fred, World Supply of Data, make a plot of the 10-year bond yield and CPI inflation. And you will see throughout the 1970s, the bond yields never went up ahead of inflation. And in the 1980s, they never went down ahead of lower inflation. So bond markets have never forecast inflation. Now, that could mean that inflation, I think I'm kind of an efficient marketer, inflation's inherently hard to predict. Inflation's like the stock market. So don't listen to too many. Why is that? Same reason as the stock market. If you knew stocks were going to go up tomorrow, you'd go buy, stocks would go up today. If there was scientific understanding, we all knew there was going to be lots of inflation next year, what would people do? Businesses would raise prices today. Workers would demand higher wages today, and everyone would be willing to pay them. So sort of the central equation for understanding inflation today is expected inflation next year, plus some sort of stimulus, output gap, whatever you want. But the expected inflation next year is always in there. So I think there's good reasons why inflation is very hard to forecast, even by bond markets. But I'm going blah, 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 because, it could, the helicopter story says you get a one-time price level jump. You hand out 30% of debt, the price level goes up something like 30%, and then it stops. And then we all go back to normal. And that's maybe what the bond market is seeing. There's going to be a one-time price level jump. Basically, the wealth tax has just been passed because they're going to inflate away 10 to 20% of the debt, and then that's the end of that. So it could be that's the end of that. Bond market could be right. It could be that the bond market's missing it like they did every time before. And I'll stop waffling on what's wrong with the bond market.
All right. So in the 2 or 3 minutes we have left, is there anything worth covering that we haven't touched upon? China?
Oh my gosh, yes. China. What's going on with markets in China is a good question. I'll just leave you with the thing I worry about. You should always worry about the thing nobody's worrying about. And we've gotten in the habit of thinking that government debt is completely risk-free. And I can see 100 ways that we could run into this is the thing they always make fun of me. This will put this at the end of the podcast where no one will hear it. We could have a global sovereign debt crisis when China kind of blows up. China is not sustainable, and that's the government's making money by selling land. And where's a bubble? A bubble is where there's a whole bunch of people have lent a whole bunch of money that can't get repaid, and all the books are cooked. That sounds a lot like China. I think sovereign debts are in trouble in Europe. They never figured out the Italy problem. If the ECB, I mentioned the Fed raising rates. The Fed raising rates would cause real fiscal issues in the United States because it raises the interest costs on the debt. If the ECB raises rates, Italy's debt's 160% of GDP. Italy can't pay higher interest costs on 160% of GDP. And if the Chinese get into trouble and start selling all their sovereign debts, who's going to be buying? And then Europe sells all its treasuries, and the U.S. is in precarious fiscal. So we are living on we're like a household in 2006 that got the teaser rate. And, Janet Yellen said, don't worry about fiscal expansion. Interest rates are low. Olivier Blanchard just wrote a spectacular book on don't worry about fiscal expansion because real interest rates or debt costs are low. It's like, don't worry, honey. They're only charging us 1% on this mortgage. We can buy the mega mansion until interest rates go up. And you look at the planning to be, we've still got structural 5% of GDP deficits, and then Medicare and Medicaid come. And the federal government is about to take on student debts and, we officially guarantee every mortgage in the country. And what happens when the pensions, state and local pensions go under? I mean, we assume that every crisis is going to get met with a river of federal cash. We just borrowed $5 trillion for COVID. Well, COVID wasn't great, but compared to the bubonic plague, COVID was kind of a sneeze. And so what happens when China invades Taiwan and the entire trade in the Pacific goes under and Italy defaults on its debts, and simultaneously, let's say Putin takes over Ukraine and the Middle East blows up, and then the US wants to borrow another $10 trillion to handle stimulus to everybody and repay everybody's debts they can. So I don't know when it comes. I don't know what it looks like, but that's the one nobody's worrying about. Now, I was worrying about this 10 years ago, and people say, well, it didn't happen, so he must be wrong. I live in California. I live on an earthquake fault. My real estate agent said, no, don't worry about it. We haven't had earthquakes in a decade or two, so it's not going to happen. Anyway, there's my grumpy economist awake at 2 o'clock in the morning.
Oh, goodness. Well, it's not quite a Hollywood ending, but it is an ending.
Well, I wanted to give you something that nobody's thinking about. So there it is.
Well, I appreciate that. And I'm sure our listeners will too, John.
The great green sovereign bubble.
Well, I hope we'll get a chance to chat again before 10 years is up so I can check back and to see if any of your worst fears come true. But in the meanwhile, I want to thank you.
My hope is that, people recognize the fears and do the simple, obvious things it takes for this not to come true. It's not that hard, guys.
Yeah. All right. That was great. Thank you so much. I hope we get a chance to talk again and see you in person maybe someday too.
Someday.
All right. Take care.
All right.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.